All right, so I want to talk about what I'm seeing for self-employed borrowers for home buying in 2021 and beyond. If you're not aware, in 2020, for conventional loan underwriting, things got a little bit more difficult for self-employed business owners who wanted to qualify for a conventional or FHA loan. Specifically, if you have a business that is your primary source of income and we're going to be using that income to qualify you for a home loan, we as a lender have to get extra documentation that's required by the agencies. This isn't something where it's optional, right? That means for you as a business owner, we have to ask for not only your tax returns for the last 2 years, but we also need to see proof that your business hasn't been financially affected by the COVID quarantines. What does that mean? Well, we're asking for your business bank statements for the last 3 months to show your recent deposits into the bank to make sure that your income for your business hasn't been affected. And we also have to get a year-to-date profit and loss statement that shows that your business expenses and income is consistent with what your tax returns show for the last 2 years. So if you have a business that was not affected by COVID and you plan on buying a house in 2021 or possibly even in 2022, who knows when these changes are going to be wiped away, you have to make sure that you have not only your tax returns for the last 2 years, but you also need to be able to have an accounting for your profit and loss. When you're going through the home buying process and you're qualifying for a loan for potentially the next 30 years, lenders have to be able to show that you have the ability to repay the loan. For a W-2 employee, that's very straightforward. We get recent pay stubs. We ask to verify your employment with your current employer by calling up and making sure you still work there. And we'll ask for W-2s and maybe even your tax return filings for the last 2 years. But if you're self-employed, we need additional documentation because self-employed people have expenses. If you write off those expenses and you don't claim that income when you file your taxes, we can't use the income to qualify you for a loan. If I have a business that grows $300,000, but I said my business expenses were $280,000, my actual qualifying income for my home loan is only $20,000. Whereas a W-2 employee who grosses $300,000, we can actually use all of that income to qualify them for a loan. When you're going through the home buying process, it's important to know how the rules of borrowing money work so that you can leverage them to be able to get the house that you want. Also, when you're sitting down with your accountant, make sure that you tell them that you plan on buying a house in the next year or two so that they don't write off every expense under the sun and you have enough income to qualify for the house that you want. It's too often that I talk to self-employed business owners who have good income for their business, but when it comes time to file their taxes, they write off way too many expenses and they can't qualify for the amount of house that they want. The alternative is, if you don't want to go through the conventional underwriting process and pay taxes on all of the income that you're earning because you're writing off expenses, the trade-off is you can get what's called a non-qualified mortgage. The difference between a conventional loan and a non-qualified mortgage is non-qualified mortgages require a higher down payment and it's a higher interest rate, but instead of looking at your income that you claim on your taxes, a non-qualified lender is going to look at the income that's coming into your business bank accounts. I've had borrowers who had businesses that were making lots of money, but they also had lots of expenses, and they knew that if they were to show all of their income on their taxes without writing off those expenses, they'd have a much bigger tax bill when it comes time to talk to Uncle Sam. If you fall into that category, you may want to look at a non-qualified mortgage and possibly claiming less income because you're writing off more expenses, but you're going to have more cash available for your down payment when you're going through the home loan process, and you're going to have to accept that you'll be paying a higher interest rate on that money. It still may make sense because for some people, a business that's making lots of money that allows you to save up a larger down payment is better than having a bigger tax bill and that money's not coming back to you. If you make a larger down payment on your house because you get a non-qualified mortgage, that money is true equity that you have in the property. As long as property values are relatively stable, if you were able to sell that house in the future, you could always recoup that money with the equity that you have in the property. If you pay Uncle Sam more money in taxes because you reported more income, they're not giving you a rebate on that. So some of the conversations that I've had with self-employed borrowers is, hey, I'm a self-employed person who's got a business that's bringing a lot of money in. How can I reduce my tax liability by being able to claim all of my expenses and still be able to qualify for the house I want? The answer may be to get a non-qualified mortgage. This is a little known secret, and some mortgage professionals, frankly, just don't have experience with it. Thankfully, I have non-QM lenders, non-qualified mortgage lenders, who specialize in these types of loans. And if that loan makes the most sense for you, we can go over that option.